Options trading. You've heard the stories, right? The ones about people making absolute fortunes overnight. And, well, the ones about people losing it all. Today, we're going to pull back the curtain and figure out what all the hype is really about. So let me start with a question. What if I told you that you could control $80,000 worth of a hot stock, like Tesla, but you only had to put up about $8,000 to do it? I know, it sounds a little too good to be true. And that, right there, is the incredible promise of options. It all comes down to one powerful concept: leverage. Leverage is the engine that drives this whole thing. So let's pop the hood and see how it works.
To really get our heads around this, we're actually going to forget about the stock market for just a minute. Instead, let's talk about something we can all picture: buying a house.
Okay, so imagine you find this house. It's on the market for $200,000. You've done your research, you've got a good feeling about the neighborhood, and you're convinced its value is about to skyrocket. The problem? You don't have the cash to buy it right now, or maybe you're just not ready to take on that big of a risk. So, what do? Well, instead of buying the house, you buy a contract. You go to the seller and say, hey, I'll give you $10,000 today if you give me the right to buy your house for $200,000 anytime in the next 2 years. What you just did is you bought an option. That $10,000 you paid, that's called the premium. Think of it as your non-refundable ticket to the game. It locks in your price and, this is the most important part, it is the absolute most money you can possibly lose. Your risk is capped right from the start. Okay, let's jump forward a year and see what happens. Scenario A, you are a genius. The house value exploded to $350,000. You use your option, buy the house for that locked-in price of $200,000, and even after your 10 grand premium, you've made a $140,000 profit. Nice. But what if you were wrong? Scenario B, the market tanks. The house is now worth only $150,000. Would you still buy it for $200,000? Of course not. You just let your option expire, you lose your $10,000 premium, and that's it. You walk away having dodged a huge bullet. And that is the magic trick, right there. You get all of the potential upside, but your downside, your risk, is strictly limited to what you paid for that ticket to the game. It's the whole reason people are so fascinated by this world. All right, now that we've got the basic idea down, let's take that same exact logic and apply it to the stock market. The first type of option we're going to talk about is called a call. A call option works exactly like our house example. It gives you the right, but not the obligation, to buy a stock at a price you agree on today, which we call the strike price. You buy a call when you're bullish. That's just trader speak for when you think a stock's price is going to go up. Let's look at Tesla again. If you wanted to buy 100 shares of the stock, it would cost you over $81,000. Ouch! But a trader could buy one call option contract instead. That contract controls the same 100 shares, but it only costs a little over $8,000. You're controlling the same amount of stock for a tenth of the price. Now that's leverage. So calls are great if you think a stock is headed for the moon. But what if you think it's about to hit an iceberg? That's where the other main type of option comes in, the put option. A put option is basically the mirror opposite of a call. It gives you the right, but not the obligation, to sell a stock at a set price. You buy a put when you're bearish, when you think a stock's price is headed down. So let's make it super simple. Calls are a bet that the price will rise, giving you the right to buy. Puts are a bet that the price will fall, giving you the right to sell. This is what makes options so flexible. You have a tool to potentially make money whether the market is booming or busting. So you might be thinking, okay, why not just buy the stock if I think it'll go up? Well, the answer comes down to that one word we keep talking about: leverage. Remember that Tesla trade? Okay, so in one day, the stock itself went up 3%. That's a pretty good day. But the call option, its value shot up 15%. The return was amplified 5 times over. This is the incredible power of leverage in action. But for every amazing story about amplified gains, there's always a flip side. Leverage is a serious double-edged sword. And the risk of losing your entire investment isn't just a possibility, it's actually pretty common. So let's look at a trade that went wrong. A trader thought Adobe stock was going up, so they bought a call option for about $192. They were betting the stock would rise above their strike price of $380. But it didn't. In fact, it fell. By the time the option expired, the stock was nowhere near the strike price, which means the option was completely worthless. The final result for the trader? A 100% loss. The entire $192 premium gone. So let's wrap this up with the most important things to remember. First, an option is the right, not the obligation. Second, calls are for betting prices go up, puts are for betting they go down. Third, the name of the game is leverage, which can magnify your gains and your losses. And finally, and I can't say this enough, you can lose 100% of the money you put in.
Look, there's no doubt that options are an incredibly powerful tool. They offer a level of flexibility and leverage that's hard to find anywhere else. But all that power comes with very, very real risks. Now, you know the basics, but the real question is one only you can answer. Is this high-stakes game the right one for you to play?